Hi, this is Leah from Trading Mastermind. Now we're going to talk about moving averages, convergence, divergence, or MACD. Well, MACD is really a type of graphic display of two moving averages. Instead of showing the moving averages themselves, it shows a different graphic indicators of the two moving averages, or in simple terms, whether the moving averages are spreading apart or coming close together. So when the moving averages or when MACD cross, it shows a change in the direction of the price may have happened. So notice that up here, in the price channel, I have 9, 12, and 26 moving average, and the 12 is the red line, and the 26 is the blue line. Well, down here in the indicator channel, I have a MACD with a setting of 12, 26, and a 9. So the red line is the MACD line, and the blue line is the trigger line, which is actually a 9 period of MACD itself. Well, MACD is the difference between 12 and 26 period EMA. So if MACD crosses above 0 line, well, this indicates that a 12 period crosses above the 26, and that's what we call positive MACD. If MACD is positive and rising, then the gap between the 12 period EMA and the 26 period EMA is widening. So this indicates that the rate of change of the faster moving average is higher than the rate of change for the slower moving average. In other words, it is indicating that the bullish momentum is increasing. So as the MACD is crossing down below the 0 line, we know that the 12 period cross below the 26 period, and that's what we call negative MACD. MACD is negative and declining further, then the negative gap between the 12 period and the 26 period is expanding, while downward momentum is accelerating, indicating a bearish period of trading. The momentum is strengthening in the downward trend. Well, down here is a histogram. It represents the difference between MACD and the 9 period EMA. If you notice, if the histogram gets larger, this indicates that how wide the distance is between MACD and 9 period EMA or the trigger line. So the histogram is positive when it's above the trigger line, and the histogram goes negative if MACD is below the trigger line or the 9 period EMA. MACD generates signals, and one of that is divergences. So MACD can either form a series of higher lows or a second low that is higher than the previous low. Well, divergences are probably the least common signal but are usually the most reliable. Well, here's an example that can help us the creation of divergences. Well, here in this chart, you can see that the price is increasing by this line drawn above the price in here. But MACD, as you can see, was falling the peaks and we're getting lower. Well, this means that there was a change, and you really can see that there was really a change right here. Here's another divergence that can help us a lot. Here, you notice from November 2007 through November 2008, market was down. And from November 2008, that's when the divergence starts forming. The price continued to go lower during the final wave of this trend. While the price is going lower, MACD is going higher, forming a clear example of divergence. Well, this divergence signaled the turn in price, and since then, price has never gone back to this low. And this can occur also in any time frame, not just a daily time frame. Even though moving averages are lagging indicators, notice that MACD moves faster than the moving average. In this example, MACD also provided us a few good trading signals. So here, in this example, MACD crosses its trigger line ahead of time. And right here, in the price channel, moving averages crosses, but here in MACD, it already happened. So MACD moves faster than the moving average, and because of this, MACD provided us trader for good trading signals. It's because when MACD crosses 0, that's the same point where the 12 EMA crosses 26, And that's the same point where convergence becomes an actual crossing of the moving average. You'll notice that MACD crosses its trigger line before it happens. One of the primary benefits of MACD is that it incorporates aspects of both momentum and trend in one indicator. As a trend-following indicator, MACD will not be wrong for very long because it is not possible for price to be going up without MACD crossing its trigger line and subsequently crossing the zero line. But what is the most useful about MACD is that it crosses its trigger line much sooner than the moving averages cross. The use of moving averages ensures that the indicator will eventually follow the movements of the underlying security. And by using exponential moving averages as opposed to simple moving averages, well, some of the lag has been taken out. And as a momentum indicator, MACD has the ability to foreshadow moves in the underlying security. And MACD divergences can be the key factor in predicting a trend change. But MACD is not good for identifying overbought and oversold levels. Even though it is possible to identify levels that historically represent overbought and oversold levels, well, MACD does not have any upper or lower limits to bind its movement. So MACD can continue to overextend beyond historical extremes. As you can see, there's a lot of benefits and drawbacks using MACD. Well, perhaps you'll enjoy using it in your trading businesses. Well, to find out what works best in Forex trading, just go to www.forextradingseminar.com.